Okay. Access to this webinar is for educational and informational purposes only. Consult a licensed broker or registered investment advisor before placing any trades. All securities and orders discussed are tracked and monitored in virtual trading accounts. Virtual account prices and returns may differ from actual trading results. Commission costs are excluded. Neither philstockworld.com nor its affiliates, nor any of their respective officers, personnel, representatives, agents, or independent contractors are in such capacities licensed financial advisors, registered investment advisors, or registered broker-dealers. Nothing contained in this webinar, website, or promotional material constitutes promotion, recommendation, solicitation, or offer of any particular investment, security, or transaction. Trading options involves risk. Visit the OCC website, www.optionsclearing.com, to read characteristics and risks of standardized options. PSW provides education and training services that are meant to teach you the risks and potential rewards of trading options. And we are not a service that tells you what to trade. We are not implying or guaranteeing any profit. As always, do not trade with money that you cannot afford to lose. Past performance does not equal future results, and results discussed in this webinar are not typical and are only valid on that specific or identified date. Your results may vary. By accessing the webinar, you agree to hold the above harmless from any losses you may incur as a result of the information discussed in the media identified above. By accessing the webinar, you agree to be placed on our mailing list and receive our newsletter. Rest assured, we take your privacy very seriously and we will not distribute or sell your information to anyone. There, got that done. Now, how are the markets doing? What's going on? Well, it seems like everybody's happy. Trump is only a little bit impeached, so everything's good there. Look, Trump is at the UN with the Ukraine, the president of the Ukraine. The president of Ukraine can either condemn Trump or make him seem innocent by simply saying, "I never felt pressured by Donald Trump to do anything in particular." Trump, but meanwhile, you can ask Trump for anything and he'll get it. Whatever he wants, he'll get now. So if I was the president of Ukraine, I don't think I would turn that down, because what your options are to either make Trump happy now, and he is the president now, and get whatever you want out of him because he got him over a barrel, or piss Trump off, and he's a psychopath. And then hope that the Democrats come into power in a year in order to be nice to you, and even then they might not be nice to you. So it's kind of a wild card, whereas you've got Trump. So game theory indicates that the president of the Ukraine is going to promise Trump that he's going to get him off the hook, and Trump is going to have a press conference this afternoon where he'll act completely exonerated, and mostly this will be kind of a waste of time. So we'll see what happens. It was very weird the way the whole thing played out. In fact, to some extent, I'm not sure Trump's people didn't engineer this to be a non-crisis in the end. But either way, so the market went up and down and crazy. And look, all this political uncertainty, we know this kind of stuff is happening. And you know how crazy things are. And that's why it was easy to go to cash last week. We talked about this in last week's webinar. It just isn't worth riding all this out. And look, since then, because this goes back to last Wednesday where we went like this since then. That's the Dow and that's the S&P. So things have gone down, not in any drastic way. And I didn't say everything was going to sell off tomorrow or anything like that. I just think the whole fourth quarter is going to be rough and annoying like this. And there's not really a benefit to playing it. There will be a benefit to bargain hunting, and we'll talk about that next. But you bargain hunt by having a clean slate, and people forget about that. Everyone's like, oh, I don't want the hassle of cashing out the portfolio and then starting a new one and blah, blah, blah. But meanwhile, it's good to take a completely fresh look at things. It's good to think about every single position you add as a brand new position, because it is a brand new position, and to say, is this fitting in with what the market's doing now? What things are interesting now going forward? What's changing now in the market? Where do I want to deploy capital now? Not where I wanted to deploy capital a year ago, 2 years ago when we set up these trades. It's different now. 2 years ago, we were very bullish. We thought the Fed was going to lower rates and step in and do whatever it took to prop up the market, and they've done that. But now I think we may be reaching the end game of that. So now we have to be a little bit more defensive and look at stocks that we feel are going to be able to weather a 20% correction in the market. That's what I'm looking for now. Stocks where I'm comfortable doubling down on anything we start with. Also, the composition of our trades is going to change. I'm going to want to take a lot smaller positions, a lot lower levels of puts. I want every single thing that we have to be something we're going to be happy to double down on if it drops 40%. That's pretty much the benchmark for where we're going to be picking up new positions. Well, good. Philip Morris, 10% today. Or was that not today? I don't get that. 39.63, that's about 10%. And somehow it only says 2.6%. Am I wrong? Well, it's not 10%, but it's $3. $3 out of 40 is a lot. So I'm not sure why. Maybe I don't want to speculate. I don't know why. Maybe the up counted and the down counted. I don't know. So they're not merging with Altria, and I guess it jumped. Oh, I see. So they're only counting this. It opened here, shot up, and then came down. So it's down 8% or whatever it is after being up 5%. So the net is down 3%. Still crazy, right? It's a major multi-billion-dollar company. So it's really tricky to play these things. So I'd rather not on the whole. I'd rather see where things settle out a little bit. So during the week, what have we looked at? I think I looked at something on Monday. What do we talk about Monday? No, I didn't have any picks there. Did I pick? Ah, here you go. All right. So Teva. So here's an example. So Teva is a really beaten down thing. They've got problems. They're involved in the opioid crisis. There's going to be lawsuits and so on and so forth. But still, as a long-term play, it's a valid company, and they'll cycle back up at some point. But who knows when? So I said, look, I wouldn't go big, and they might go lower. But since you can take $100 credit on 5 short puts and 10 longs, wait. Oh, no, I was talking about somebody adjusting there, but conceptually, you can sell the Teva, what were they? The $10 puts. So you can sell 5 of the Teva $10 puts for $2,300. Because they must be $460 each. So for $460 each, you can sell the $10 puts. Now they're at $660 roughly. Where's the number? 7, last close, 680. Anyway, so they're at about 660. TEVA. Or 7. Let's see what they are right now. So if we find Teva, and I'll tell you what the logic is here, because so Teva, they're at 7, and if you sell the $10 puts for $4, okay, you're netting in for 6. All right, so that's still $1 lower than we are now. But on the other hand, though, you have the upside all the way to $10. You're going to make more money. So you get a $1 bonus, plus you can make another 3 between here and $10. So if you bought the stock for 7 and it went to 10, you'd only make $3. So you're going to make as much money as if the stock goes to 11, practically doubling. If it just goes to 10, which is up 50%. And your risk is that you're going to be assigned 500 shares at $6, $3,000. So the only risk you're taking here, collecting $2,000 for 5 shares. And I'll show you how that works. You say sell, single, and my default is 10. That's very important, by the way. If you're using Thinkorswim and you have small accounts and you don't want to do it, you make sure you set your default to be a low number. That way you don't accidentally order too much or do something. So it's at 4. TIVA's gone down a bit today. I would ask for at least 405, probably 410, because generally I want to go 5%. This is an important thing too for portfolio building. I generally will ask 5% in my favor. So if I'm buying something, I offer 5% less. If I'm selling something, I offer 5%. I ask for 5% more, because I would rather get the 5%. I'd rather not fill it than not get my 5%. So so I'm willing to wait and see if I get it. If I don't get it, then I'll rethink the trade and decide what I want to do. But generally, if the market isn't, if I don't believe something's going to get away from me, if I think something's sort of in a certain area, especially something like TIVA where it could easily go lower, why should I pay any more than I have to? And I look to see what the last trade is to see if it's realistic, and the bid and the ask is $4.410. The last was 405. It's going down today, so I don't see why, and plus it was lower before, so I don't see why I shouldn't ask for 410. So then I confirm it. Oh, and if you're doing that, of course, you're going to put it in, this says for a day or good to cancel. So you put in good to cancel, and it's going to sit there until it fills. Then you send it. Now, your buying power effect is only $706, so it's very margin efficient if you're collecting $2,000 to start. And it's a nice little trade to put in your portfolio. So if TIVA goes lower, then I will own it for 6, and then I will decide if I want to sell the $6 calls, though there are no $6 calls. The $5 calls are $3. The $8 calls are $170. So I could certainly sell the 5s for $2 before I get in too much trouble. That would then lower my basis to $4. So in other words, if I get it signed at 6, and then I get it signed at 10, but I already collected 4, so the net is 6. Then I turn around and sell the $6 calls for $2. That drops my net to 4, and if I'm called away at, if I'm called away at 5, so the $5 calls for $2. If I'm called away at 5, I'm still making 25%. So right now it's at 7. If it drops $2 out of 7, which is like 30%, so if it falls 30%, I can still make 25%. And that means my break even is 25% below 30%. So it would have to fall more than 50% for me to lose money on this trade. That is the kind of trade I want to go into in an uncertain market. TIVA's got to lose 50% before I lose money on this trade. Because I can knock my basis down to $4, and that's only between now and 2021. Oh, in fact, here's 2022s. I didn't notice those were out. So if we use the 2022s, I can sell the $7 calls. Now it's interesting. There's different numbers. In 2022, I could sell the $7 calls for $2. Last was $240. Now $248 is the bid, and $280. So between $250 and $280 is $275. It's 260. Roughly $255, $260. The last was $240. So I would ask for $260 on this one. So I'm sorry. So now I've changed my mind completely because I didn't realize there were 2022s out. I got to get used to looking at those. But I would then go to sell single. And now instead, my net's going to be so low, I might sell 10. And now I sell the $7 puts. We said we were going to get $260 for them, right? And now it's using more buying power because I'm agreeing to buy $7,000 worth. $7,000 worth. But my net, since I'm collecting $260, okay, so my net collecting $260 is really going to be $440. So I'm agreeing, instead of agreeing to buy 500 shares for $6, which is net $3,000, I'm now going to buy 1,000 shares for 440, so it's $4,400. So for $1,400 more, for one half of what I was willing to pay for 500 shares, I'm now going to have 1,000 shares. I'm going to double it up. So I'm already basically offering to double. I'm already doing my double down for half. And again, this is proportional to a $100,000 portfolio where my trading block would be at least 10,000, basically 20,000 with margin. So it's not breaking the bank, even if I get assigned. The worst that's going to happen to me is I'm going to end up owning $4,400 worth of TiVo. Okay, and again, that would be down at net 440. And right now you can sell these $4 calls for $385. Somebody just bought it for $385. That's crazy. So if our net is 440, we're not, and again, we're not selling it now. You assume there'd be damage done. But if you think about it, if your net is 440 minus 385, that's 55 cents a share. Do you not want to own TiVo for 55 cents a share when it's $7 now? That makes it easy. Oh, look, it's falling right now. See, I told you, that's why you offer less. They just fell like 3 or 4 cents while we were talking. Anyway, realistically though, you figure, okay, well, the reason I would be assigned is would be because it falls another couple of dollars. So what I want to do is look above the 4s, $2 at the 6s. There are no 6s. There's 5s, and the 5s are 60 cents less. So figure another, and the delta's 80. So I would give it the 160. So if the delta's 86, I would subtract 160 here and say that if TiVo falls $2, this will be about last is 385. This will be about $2.25. So now my expectation on the trade is that if I get assigned at 440, I would sell for 225 the $4 calls, and my net is 215. And don't forget, that's still on only 1,000 shares. So I'm not really, my allocation isn't as bad as you think it is, because even though I'm agreeing to buy 1,000 shares for net 440, which is $4,400, I know I'm going to immediately flip it and sell some calls. Now I've only allocated $2,150 to my initial TiVo position. And if I do get called away, so then two things can happen. Either I'm going to get called away at 4 with almost 100% profit, despite the fact that it drastically fell on me, or I'm going to end up owning TiVo long term at net $2.15. I don't mind owning TiVo at net $2.15 long term. I don't believe they're going to go bankrupt. Unless I believe they're going to go bankrupt, there's no logical reason not to own them. Because at $2.15, I can always make money. Here, in fact, I'll show you. Let's look at Hovnanian. Are they still cheap? I don't know if they're still cheap anymore. Let's look at Hovnanian. No, damn it. Who's really cheap? What's a $2 stock? Does anybody know? Can anybody name one? I'm looking for a $2. I'm trying to think of a $2 stock that has options. Hovnanian used to be, but they did a splitty thing. GNC. Ooh, good one. Okay. So GNC. Do I think GNC is going to go bankrupt? No, I don't. So if you own a stock for $2.40 long term, what can I do with that stock? Well, first of all, I can sell the 250 calls in January for 40 cents. Okay? So if I own this stock at 240 and I sell right now, where'd my calculator go? I broke it. Okay, that's better. All right, so I own the stock for 240. I sell what calls did I say? The 250 calls for 40 cents. So now I have a net $2 in the stock, right? And now between now and January, which is only not even 3 months away, just a little less than 3 months now. So January expiration, 3 months away. If I get called away at 250, I make 25% in 3 months. Okay. If I don't get called away at 250, instead of making 25%, what am I going to do? I'm going to turn around and I'm going to sell Probably not March. It should be April by then, but realistically, so let's say I sell the April calls and I get another 40 cents. That then minus 40 drops my basis to 160. And I'm still selling the 250 calls, if there are 250 calls then. So I'm still selling 250 calls for 40. Okay, fine. Now I either get called away 250, except now my gain is 90 cents, which is, I don't know, it's more than 50% of 160, or I keep it. If I keep it, I sell more calls, 40, and don't forget this is every 3 months. And I'm collecting another 40 cents. And now my basis is 120, and if I get called away at 250, that's clear. That's a double right there at least. And then obviously 3 more quarters of selling, and I've got a zero basis, and that means that every time I sell, I'm collecting money. Now I'm paying myself a dividend, but that dividend is $1.60 a year on a stock that was $2.40 in the first place. So unless they go bankrupt if they go bankrupt in 18 months, I will break even on my call sales. If they go up and I get called away, I'm going to make probably a double overall. If they go down, even if they go down to 60 cents or 120 or something like that in a year, I don't care. I'm still making money. I'm still selling 40-cent calls against the position. That again, this is again the kind of stock I want to own, unless they're going to actually go bankrupt, close all their stores and zero out like Helios Matheson did to us, although they're not bankrupt. HMY came back. Although they're coming back as a joke, but you know. Where's my charts? That's when we totally gave up on. But I did say when we were closing out the portfolios, I said you don't want to sell them because they're not bankrupt yet. You know, surprising as that was. But look at them, they're up to 0.5 cent. They almost did a penny the other day. So they've come from 0.1 cent or 0.2 cents, and now they're up to about 0.6 cents. Not certainly nothing exciting about it. But the point is, they're not dead yet. You can't sell options against them, unfortunately, but they're not dead yet. Oh, what are you doing? Pick a time. Pick a day. I don't give a shit. Just go away. All right. Now, what was I saying? Oh yeah. So, you know, in this kind of environment, I'm going to be making a lot of picks like that. It's very different than what we've been doing because now we're going to, and again, it goes back to the old be the house strategy though. We're not cowboying it like we have been. We have been very aggressive. We've taken a lot of positions. We've taken some stocks that we were hoping to double, triple, blah, blah, blah. And it's worked out. And we had phenomenal returns. But now I just want to make good money. And I'm going to just make good money by picking a lot of stocks that we're going to just say, look, this stock is so low, and it doesn't have to be low physically in price. It has to be close to value. It has to be of a value that we feel that is something where there's a real floor there, and if it goes lower, it's just a mistake the market's making, and we don't mind investing in that floor because, again, they're not going bankrupt. And this is exactly what I told people in 2009. And obviously, this is well in advance. But you know, you've got to go look at stocks that you say to yourself, okay, even if it seems like the world is ending, even if there's all these problems here, what are the problems that we're really, really concerned about? The big trend problem over the next decade is global warming, right? So you don't want to pick a company that's adversely affected by global warming. That means obviously you don't want to buy Florida real estate, you know, for a starter. You don't want to buy, this is one of the reasons that we do like the orange juice thing that I talked about the other day, because those crops are going to get impacted. You don't want companies that are heavy fossil fuel emitters, because no matter who's the president of the United States, eventually the entire world is going to force us. And I mean force, because when the whole world decides, and they all signed the Paris Accords, every country except for us and like Brazil and somebody stupid, like, I mean, you know, some really, okay, here. This is an important point. I mean, it might not even be Brazil, actually. who did not sign the Paris Agreement? See, that's a question people ask. Who did not sign the Paris Agreement? Who signed? Who left the Paris Agreement? How many countries signed the Paris Agreement? Which countries have not ratified? Okay. 13 nations haven't ratified. Okay. This is no longer true, though. I think most people have ratified. But it was Russia, Turkey, Iran. This is our company. Russia, Turkey, Iran. Oh, wait. Why is it only 3? This article was updated. Liberia, blah, 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 as of February, the countries yet to formally ratify were, okay. Understand that we ratified it, obviously, under Obama. Trump took us out of it. Angola, Eritrea, I don't even know what that is. Iran, Iraq, I don't know what that is. Lebanon, Libya, Oman, Russia, South Sudan, Suriname, Turkey, and Yemen. Those are the countries that did not ratify the Paris Accords. I believe that Russia has since ratified. So this is updated as of February 4th. I'm pretty sure Russia did ratify. So we're in there with these guys. And 197 countries have ratified, or whatever the number is now. All right. At a certain point, they're going to be going through all these struggles and hardships, and they are going to say, hey, you 10 countries who didn't ratify yet, you're going to start adhering to it too, or we're going to put trade embargoes on you and blah, 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 and we'll put sanctions and so on and so forth. And the rest of the world, the entire rest of the world, embargoing and sanctioning us is going to force us to do it. They don't need to go to war. They just basically destroy our economy if we don't play along. Not only that, though, but 1/3 of the corporations on the planet have signed an agreement saying they won't do business with people who haven't ratified the accords and so on and so forth. That's going to be us too. So we're going to get pressure from the corporations inside and outside the country and from all the governments and so on and so forth. Anyway, so that's a big deal going forward. You don't want to be investing long-term in carbon emitters. You don't want to be investing long-term in coastal real estate, things like that. And that, by the way, would include like wind farms that are built off the coast now. If the sea level rises, they're going to have to move their wind farms and incur a lot of expenses, and storms will get worse and they'll knock down the windmills, you know, and whatever else happens. You have to just think, who would have a problem with changing weather, changing temperatures? People who insure hurricane damage, I would stay away from people who are trying to insure against hurricane damage. That's bad. But on the other hand, someone like Home Depot who fixes your house after a hurricane, those guys will do probably very well. And then you have to factor that in, though, with how many stores do they actually have in Florida and Texas and other coastal areas, because everybody in these areas has to move. You can't save Florida. I live in Florida now. You can't save it. It's gone. 50 years from now, Florida is going to be about half the state it used to be. There's basically no way to stop that. The sea levels are rising, the storms are getting worse, and Florida is only a few feet above water. The entire landmass of Florida is barely above water. So you can't save it. You can't build a wall around all of Florida that's going to keep the sea out. That's what they tried to do in New Orleans and didn't work too well. And that's going to get worse. It's another city that'll be gone. But, you know, Miami and down there, all gone, all the way, probably up about almost halfway up the state, is going to be just overrun by ocean. So, you know, you have to think about how that affects things. How does that affect Disney? Okay, where's Orlando going to be? And not all 50 years, but 100 years or whatever. But the point is, over the long term, it's just going to get worse and worse. And it doesn't have to be underwater to be uninhabitable, because if you're in Fort Lauderdale and the ocean moves up a couple of feet, and every single time there's a major storm, the whole town floods, you pretty much can't live there anymore. It doesn't work. It doesn't have to be destroyed. It just has to be like ridiculous. You know, you can't live in a major city where it's constantly being flooded. And then what are you going to do? You're going to build giant walls to keep the sea out and so on and so forth. And that's going to cost billions of dollars. And who's going to pay for that and so on and so forth. A lot of things you got to consider in long-term investing. So we want to pick things that we feel are safe, good, long-term strategies. Oh, MDR, that's a good one, Jeff. Thanks. Okay, so MDR is another low. I'm pretty sure he's naming that because it's a low cost. Now, we don't know that MDR is not going to go bankrupt, so this wouldn't be, yeah, there you are. But again, it just gives you an example. MDR is $2. The January 22nd, or the January 2022, sorry, calls, they were going for 130. So you net into that for 70 cents. But that wasn't the point, because the point is I don't even want it for that. But what you're going to do is, let's say you sell the 150 calls for 90 cents. That's net 60. So that would be your starting point on MDR, would be net 60. So your worst case in MDR is you're going to get assigned at net 60, which is 1/3 of the current cost. So that's your worst case for an entry. Now, if I had confidence that MDR wasn't going to go bankrupt between now and then, that'd be great, but I don't know. MDR is too crazy volatile for this sort of thing. But you get the idea. The point is to look at a stock and be like, well, that's ridiculous because they're not going anywhere. And not all of them are going to be bargains because some of them are expensive, like Home Depot, like I just said, is going to be around. But they're not cheap. And I can't get enough of a discount to make myself happy. They're $225. Not terrible. I could sell without doing the valuation. I mean, I can sell the 155 puts for like 750. Okay, that's not terrible because that nets me in for 147.50, which is, you know, quite significant discounts, probably a 30-something% discount to where it is now. So that's more of like they're not going to go bankrupt. That's more of a valuation issue. But we also do tend to shy away from those kind of stocks. You don't want to be, look, it's an allocation thing. You don't want to use up too much of your portfolio if you do get assigned. You want to have the flexibility. But on the other hand, you also want to make some coin. So I'm not going to accomplish that with Home Depot, but I am going to accomplish that with GNC because GNC is going to put a significant amount of money in my pocket. I can, in fact, if GNC goes well, I'll make 60-70% my first year just selling calls. Whether the stock goes up, down, or sideways, I don't really care. I can make, as long as I make 40 cents a month against my $2 entry on the stock, what do I care? So, and again, as long as it's not bankrupt and I can still sell calls, I'm going to be a happy camper. Oh, CarMax, that was one we liked. Now, CarMax, we were hoping would go lower, but they didn't. They spiked up and they spiked down and blah, 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 but they're back to where they were. I really like the valuation on CarMax. Their earnings came in and their earnings were good. So there's nothing wrong. They're still in the same valuation. Again, though, here's one I identified. They're at 85 or 86 or whatever. I said you can sell the 2022 $70 puts, so you're getting a 20% discount at 70, but we're then selling them for 8, so that's another 10% off that price. So now we're into a 35% discount, so we're all the way down to net $62 before we end up owning CarMax, and here's 62 down here. So what we were hoping was that they would come down to 75 and then we could sell these things for a better price or sell the 55 for the same price, something like that. But either way, we're collecting substantial, so that's 2022. So in KMX, and again, this is how we rebuild. Now, that wouldn't be appropriate for a small portfolio, but for a larger portfolio, I like it because realistically, I don't have room to own KMX in a $100,000 portfolio. It's too much. But $70 puts, sell, and a single, and let's go to $8, let's say. So if I'm selling, and again, I'm not going to sell them if I can't sell them for 8. I don't want to do it. I only want to sell it if I get my price. But I confirm that my buying power effect, I'm collecting 8,000, it's costing me $7,000 in margin. Fine. I don't mind that, because realistically, if that's my allocation block, but I'm only putting aside 7,000 in margin, which means if my allocation blocks are in a let's say in a $500,000 portfolio, my allocation blocks are going to be $100,000 each. So in other words, you figure 2 times you have in margin. So if I have a $500,000 portfolio, I have $1 million in margin. So I'm going to have, actually, I'm sorry, I'm going to have 20 allocation blocks of $50,000 each. This is only using $7,000 for me to collect $8,000. Now, the question is, though, against my allocation block of $50,000, what does it mean to make $8,000? Well, it's not that much. It's only 20, what is it, 18%? Is that right? No, 16%. So I'm only making 16% over 2 years on the allocation block, but I'm not actually using it. So it's a little tricky there. In other words, I can sell multiple puts against that, but if you do have to be careful, because if the market really collapses, you'll get assigned to all of them at the same time, and you won't be able to afford it. But since my allocation block is $50,000, I can sell the put and not be too worried about it. So I only really have to put aside the 7,000 I'm using. So so in other words, if I have 20 allocation blocks in a $500,000 portfolio, like the long-term portfolio was, I have 20 allocation blocks. I can afford to have 20 short puts that are like that. So that my worst case is I'll end up owning 1,000 shares at $70. Which I'm sure you know only uses $35,000 in margin if I do own 1,000 shares at $70. So I've got plenty of margin to cover that if I have to. And especially assuming they don't all get assigned at the same time. And we would stop out, we would have short covers and hedges and so on and so forth. But as an initial block, I don't mind. This is what I'm saying, I don't mind owning them if they get that cheap. And that's a valuation issue. So that's the kind of stuff we're looking for. It's going to be a combination when we rebuild the portfolios. But that's another good example of one that we like. Here's MDR. And I said on the whole, it's just a week now, so there's nothing exciting going on with MDR. I talked about how we're shorting Netflix, went down nicely. We shorted CMG, went down nicely, and we shorted Tesla, went down nicely. So those we were talking about, like, do I want to set up a short portfolio? I said in the hedge fund, we have these 3 shorts. And they all did exactly what we thought they would do this week. So hopefully that'll continue. I said CMG is my favorite short. We talked about this trade on CMG. And again, here we're taking, this is what you would do in the short-term portfolio for long-term portfolios. The short-term portfolio would be, if you have a long-term, it's $500,000, you have a short-term, it's 100,000. A trade like this is reasonable because did I rate the margin? The margin was 17,000 in margin. So for 17,000 in margin, you can make about 40,000, not 40, sorry. You make about $20,000 plus 4,800 for selling the puts, and then you can make a few put sales like that along the way. So you make quite a lot of money on this. You make probably $40,000 on this spread and only putting aside $16,000 in margin, and it's a hedge because if the whole market goes down, CMG is almost certainly going to go down with it. So here we bought the in the money $1,000 puts. We sold the 860 puts, which were at the money. So basically, if CMG just doesn't go higher, we're going to make all this money. And then we sold along the way. So we're talking about there's just different ways we're going to make money in a flat or bear market. And that includes buying longs that we think are incredibly good values and selling some stocks short that we think are definitely not going to do well. Oh, I was picking a few things I like here. There's BBT. I said I like them. They're merging with STI, or they're buying STI, whatever. But anyway, so BBT is buying STI. They're going to together be about the 6th largest bank in America, but they don't get the respect they deserve. Probably they'll break out of this range. I think that if BBT wasn't doing this acquisition, they would have already popped up a lot higher. But they're a good buy. I said now the Hovnanian has made a comeback. Lennar is a good pick, and Lennar did pop in the last couple of days. It was 55, I guess. I like Travelers. Travelers, I think, is again, it's insurance, but they're mostly business insurance. They don't do a lot of property and casualty. I think I wrote business insurance is 25%. The rest is mainly homeowners. Oh no, sorry, they do have homeowners. So, you know, they will pay out over damages and stuff, but on the whole, they're very diverse. So I like them. Here's Valero. They make their money off of the spread between gasoline and oil. So when oil comes down, it's good for Valero actually, because it takes longer. As you know, the price of oil can drop pretty rapidly, but you don't really see it at the pump. That's Valero making extra profit. They're a huge refiner. Wells Fargo is the bank that got in huge amounts of trouble, and I like them as a long-term play. Goldman Sachs always finds a way to make money, so they're good guys to have in almost any kind of market. You know, and that's notice what we're picking them. Things are like very solid, very conservative companies. United Rentals, good company, renting construction equipment. Now, you think if the construction industry is going down or has problems, that URI would not be, United Rentals is not going to be a good bet. But what happens is if construction people are not very sure that this project is going to lead to another project, they are more likely to rent their equipment than buy it. So in other words, they'll go to URI and rent equipment for this specific project because they don't know that there's going to be another project they're going to move the equipment to next. And there's nothing they hate more than idle equipment. In fact, funnily enough, URI just ordered a commercial for them. I think it was this morning, actually. It was either early this morning or late last night. But I just saw a commercial for URI, which I haven't seen in ages, and suddenly I saw it. And they were talking about their new computerized system to optimize your equipment and make sure, because again, the thing that these guys worry about, construction project managers worry about, idle equipment. Any idle equipment means they paid for it and it's not doing anything. So URI is saying, hey, not only do we stop you from buying crap and having it sit around not making any money for you, but we're going to manage our own equipment and make sure that the stuff you've rented is being put to use, and we'll optimize at all times. We'll keep your rental equipment functioning as much as possible so that you don't misallocate your resources on a job site. And that's huge. You know, that's really smart. They're putting, you would think that's not a place you'd be using computer technology, but what they're saying is, look, we've used AI, and now that AI is something we can box up and put on a job site with you, and that AI is going to monitor all the equipment we rent you. Now, again, think about it. The more equipment URI rents you, the more their system can keep track of, and it can't keep track of, or it probably could if it wanted to, but it won't. But it's not going to keep track of the non-URI equipment. So now you're motivated to use an entire job site filled with URI equipment because this little program is going to make sure every single thing you have out there is being utilized fully. And if it's not, it's going to pull it back and put something else in or whatever. And there's all kinds of adjustments you make in construction because there are certain size loaders and bigger things and smaller things, and you can adjust the amount to make sure you're fully utilizing the machine. So in other words, you know, sometimes you can have a machine that's just too big for the job. You got 10 guys and they're on a job and it takes them this amount of time. Now you got this great big front loader and it does the job in 3 days, but meanwhile that means 2 days they're sitting around twiddling their thumbs because they're done already. So you can lay off a couple of guys, or you can get a smaller machine, or a little bit of both and save money. You know, that's the kind of stuff that you want pointed out to you. And it's, you know, when you're managing a big construction project, you can't watch all that stuff that easily. But these machines will pick up on it because they'll know exactly when you turn them on and when you turn them off and everything else. So I like that. Caterpillar, of course, makes the machines, and we always like Caterpillar when they're cheap. of course, this is a watch list. That means that we're waiting. We want them to pull back. We want to see these guys come lower, and then we'll jump on. So in other words, you look at these channels, obviously Caterpillar's in this channel. When it comes down here, we want to buy Caterpillar. That's when we're going to get into it. Not now, it's too high. URI too, we want to see them come down in this channel. We want to see Wells Fargo come down in this channel. I don't think it's really going to go much lower than it is now. You know, and again, you don't have to buy everything on the list, but you want to, as you build it, you want to diversify. So I say, oh, good, I have a rental company, I have an equipment company, I've got a bank, I've got an investment bank, I've got a regular bank, I've got an energy company, I've got an insurance company, I've got a builder, I've got another bank, so maybe I don't want to have two banks. You've got to diversify, you've got to have things that are solid, big companies. Honestly, so none of these are small companies, these are all multi-billion-dollar giant companies. Most of them pay a dividend. That's another couple of percent we can count on getting. You know, is every little bit helps. You know, when you're in a recession or possibly going to a recession, every little thing helps. And you want to make sure your stocks have every single possible advantage going in. And that's what we're going to be looking for. So we're taking a quarter off, but we're not going to sleep. We're taking a quarter off, and we're going to be making lists and looking at stocks and going over things and deciding how we're going to build our next portfolios. And they're going to look very, very different than our old portfolios. It's not going to be the same at all because we're getting a lot more defensive. And we're also very, very, very unlikely to make the kind of money we made in the last 2 years. We're going to make good money. We'll make our 20%. We'll make hopefully 40%. But will we make? I mean, we've been averaging 60, 70% a year, and that is not likely because we're going to be a lot more defensive. We're going to be choosing things that are more geared towards just paying us over time in a reliable fashion. Because I do not want to risk too much until, I'd say probably, I mean, when are things going to get better? That's the question. When are you going to be able to sit back and relax and say, this is not a problem, we got this? I don't know that that's going to be realistic. I don't know if any time that Trump is still president that'll be realistic. And I think that the year we elect a new president is still going to be very volatile until you see what the policies are. So unless we get a good correction, which you look at today, the Dow's up 150 points now. Unless we get a good correction, it's going to be very hard to dive back in the way and be aggressively long as we've been for the last few years. You know, at these levels, it's hard to get too excited about things. So what else? So yesterday we said soybeans seem kind of cheap. And they're still cheap, so you can still do this trade. Oh no, I'm sorry, that's old. Silly me. That's our old soybean play. Sorry, yesterday we liked orange juice, which is still very cheap. There's no ETF for orange juice. You have to play it on the ice, and if you have Thinkorswim, you have to tell them you want to play it on the ice and pay for it for the access. Coffee was getting too cheap yesterday. It was in the 90s. Now it's back at 101. We like coffee. In fact, we put, aside from the ETF play, we liked, I said 100 was a good floor. And if you look at coffee now, where is it? Coffee. Soft. See what happened since yesterday? So yesterday morning, we were down around here. And we went up and down and down and up. So, you know, you have to, it's a volatile, stupid thing to play, but it's fun. And I'm sure the ETF is up too. So that's up $1. So, you know, and again, it's not a big deal, but honestly, with the ETF, what were we going for? In fact, I said, see, and again, this is an example of how we're being conservative. I said sell the 30 puts. It was at 32.50 yesterday. And I said sell the 30 puts. So way down here, we're selling puts for $1.40. Then we're buying the 30-32 spread, 30-32, still below where it was. And all it has to do is stay here, and we have net 400. And by March, we're going to get 2,000 back for a $1,600 profit. That's 400% between now and March. Very, very low risk. All that can happen to you is you get assigned 500 shares of Joe at $30. You know, and that's not nothing. It's $15,000. But again, it goes back to them. What do we do with $15,000? JO. So if we got the shares at that price, the $30 calls now are $480. And what are they at? 30? Well, forget 33. So let's say we got this. Let's say we only get 350, 360. Okay, so we're getting assigned at 30.40. Okay, because we paid the $400 net for the spread. So we get assigned 30.40 per share on 500 shares. I'm sorry, it would be 30.400 divided by 500 is 80, right? Okay, sorry. So it's 30.80 because it's only 500 shares. So we're assigned 500 shares of 30.80, and we sell the $30 calls and figure for $2 less, so 360. So I say minus 3.6, and we'd be down to 27.20, which is crazy low for this ETF. It's incredibly unlikely it goes that low. And that's just between now and March. And then we're back into the situation we were talking about with GNC and whatever else started that conversation, is that now we're in a position where every 177 days, we're going to be able to pick up 10% of the price of the stock, 10% of the value. So that means in 4 quarters, we're going to pick up 40% of the price of the ETF. In 8 quarters, 80%. So 2 years from now, without selling any more puts, we essentially have JO, the ETF, for free. And then we're making money on that. And that, by the way, is why we the reason we ran the portfolio so far, we used to always close out our portfolios when they hit 100%. But this cycle, I wanted to show people how much more powerful the system becomes when you do let it run. And this is exactly why it does, though, because you don't necessarily see it that way, but we keep dropping the cost down. And where does the cost go? What really happens is you don't see it as a profit because JO hangs around at the 30 level. So you don't see a huge profit in JO, but what does happen is every quarter we're dropping 10% of the stock price into our cash pot. And that's where the gains are coming from. And it does get more and more powerful. Why does it get more and more powerful? Because after 2 years, after 8 cycles of getting 80% of your money back, we effectively have enough money to buy another thing like Joe. And then we start building that up. So what's happening? The second we pull the trigger and buy another stock like Joe that we're also going to collect 10% per quarter on, now what's happening? Now the same initial investment that we made in Joe is now pulling down 20% a quarter, sorry, 20% a quarter. So the next year, not the next year, the next cycle, the next 2-year cycle, after the first one, the same investment that started out making 10% a quarter is now making 20% a quarter. And 2 years after that, then we have 4 stocks like it that are making 80% per quarter of the original amount. And that's why our portfolios have this sort of hyperbolic curve, or parabolic curve. They make a parabolic curve higher as they get older because more we layer it on, the positions become bigger. We had $1 million something worth of positions in the long-term portfolio. It's only a $500,000 portfolio when it started, and now it's got over $1 million worth of positions because we keep reinvesting the profits and moving them forward. That makes it very powerful. That means if we have $1 million+ of positions and they make 10%, that's $100,000. That's 20% of the $500,000 we started with. And that's how come we were gaining towards the end. We were gaining 10%, 20% in a month. Because if we had a good month, it would be 20% of the 500,000 that we would gain. But it also makes your losses look insane as well. Why am I on this page? What are we doing? Oh, I'm sorry, this is the next day. This is Tuesday. La-di-da. Okay. I think I had some more trades yesterday. Here's AT&T we talked about, but again, it's too expensive right now to buy. This is just helping somebody adjust what they have. Here's Chipotle we were talking about again. Talk about Chipotle locks, it's really big in the hedge fund. Oh, Noodles, that was a good one. So while we were talking about Chipotle, I looked at Noodles again, which I keep looking at. I like these guys. I think they're definitely too cheap down here. And I wrote up a little thing on them. And again, this is a nice cheap one. I like these. I like them when they're this cheap because they, you know, anything below 10 bucks, it's so easy to make your money back on options. It really is just a question of saying, are they going to go bankrupt? If they're not going to go bankrupt, we're going to make money. And we'll take a look at Noodles. NDLS. And again, I don't have any, there's no compelling reason right this minute to take Noodles, but I can sell in only 233 days. I can sell the $5 puts for 80 cents. Okay, and 80 on 5 is 40, no, 80 divided by 500, 16%, right? So in 200 days, I can get 16% just selling the puts. So again, very, very mindless, right? You can do that easily. If I do get assigned, then my net would be 420. And if it's 420, and I could, even if I could only sell these things for $1, the $5 call is for $1. Then my net goes down to 320. Now 320 is currently at 575. So if I'm getting $1.50 off 575, that's, you know, 30% or whatever. So in just 200 days, I'm knocking off 30%. In 2 years, I will have a free stock. So unless here's the logic. Unless I think Noodles is going to be bankrupt in 2 years, then almost anything I do is going to result in me having a free stock. So I will get, and again, it's not free. It won't look like it's free. On my spreadsheet, though, it doesn't matter. What's going to happen is I'm going to buy a block of Noodles, and whether I sell the puts and whether I do, however I do it, I know I can get my money back. So I'm going to take a block of Noodles. I allocate $10,000 to Noodles, and I know that in 2 years, I'll have my $10,000 back one way or the other. Through the sale of puts and calls and so on and so forth, regardless of whether it goes up or down, I'm going to have my $10,000 back. So do I want to double $10,000 in 2 years? Sure I do. Any gain in the stock is a bonus for whatever I end up still holding at that time. And then I will have doubled my investment in Noodles. And if I still like it, I'll stick with it and I'll collect twice as much money in the next 2 year cycle. Why would I not want to play this? So what happens is we watch these things, we put them on a watch list. Our first step is usually to sell puts and then see what happens for a little while. And if we like it, then we'll probably add a bull call spread or something like that to the position. It's a very simple strategy for building our portfolios, though. You don't do it all at once. You leg into it. You nudge into the position over time. There is no hurry when you're making when your base play is to make 100% in 2 years. It doesn't hurt you to wait a quarter or two to make sure they're not going bankrupt or to make sure they're on a good track. And yes, some will get away from you and some will dive on you, whatever, but you will know more. You'll understand the stock better by the time you do play it. You'll decide how you want to play it. So that's that one. I really like this one. Because I mean, again, they've got 400 stores. They have good growth. They're early on in the franchise. They're not losing money in any, certainly not in any large way. In fact, you can see that right here. They had 400 million in sales. They started to try to expand. Some of it went well, some of it didn't. But the bottom line is now they have 400. Now they have 460. So it didn't go terribly. They've grown on an average of 5% a year. It didn't go great, but it didn't go terribly. But now they think they've got a handle on it. They've trimmed their costs. So the same 460 here, right? 5 million off. The same 460 here, they were losing 13 million. Here they did a big expansion. They incurred a lot of costs to expand. So whether it was a good or bad idea, who knows? But they trimmed their losses from 70 to 37 to 8 to nothing. I'm sorry, that's a trailing. This year they expect to actually make a little bit of money. Next year they expect to make a little bit more money. The whole company at this price is $250 million. If they make $10 million, their PE's dropped to 25 already. They go a few more years and make $20 million, their PE is 10. Then obviously they're cheap. Meanwhile, the way we're playing it, we're going to get all our money back in 2 years and we'll have double the investment right about the same time that they start justifying their a higher than 250 valuation. So I want to have double the amount of noodles at the time that they start showing 20 to 30 million in profits and people start going, holy cow, we should really get in on this stuff. So it's a long range plan when you're doing these investments, but the short range is we make 50% a year. So the short range doesn't suck, it's just not as exciting as we're kind of used to. And this is what I really want to talk about these things. You really got to forget that, okay? It's not realistic. You had all the governments and all the Federal Reserves and all the central banks are all lined up trying to make you rich and pumping money into the economy and so on and so forth. And that was lovely and very nice of them, and thank you very much. But you can't expect that to go on forever. There's probably going to be some kind of a pullback. And if there's not, then fine. Then we'll make 50% instead of 75%. I can live with that. But we're putting ourselves in a position where even if we fail, we're going to do well. Even if the economy fails, we're going to do well. Here's let's go talk about Chipotle. But see, here's Chipotle, which is just like Noodles. Noodles is, when they were down here, Chipotle had been around for quite a long time here, but they were just chugging along. Then they caught on and people started buying. It went crazy. Then they had their little problems with the food poisoning and stuff. And they dropped. And now since then, they've come all the way back. And now they're back to basically right where they were over here. But it's not that different. And they're right about at the point where they did fall to pieces. So we'll see. Now, they fell to pieces because they did something bad and because people got sick and they had problems. They did poor PR. You would think they won't make that mistake again, but it still doesn't mean they're not going to drop some. I don't think they're going to drop back to $275, but I do think they're going to drop back to $600. I think that's more of a realistic price for these guys, 600, even if you do count for the good growth and everything else. And I pointed out that, like, look, the reason they're doing well, these are years. So this is probably 18. I don't think they had 19. It was 18, 17, 16, 15. So you can see where their money's coming from. They're advertising like crazy. So yeah, but that means that there's a permanent, here's their restaurant operating costs. Now notice their restaurant operating costs are shooting up also. Okay, because of advertising expenses, because of promotionals, because of discounting, their cost of labor is shooting up. Realistically, it's physics. I mean, you can't just keep growing at the pace they're growing. You eventually run into issues. Who was it? GM? GM just had a worker strike. At a certain point, you become so successful, your workers start noticing that you're not paying them enough compared to how much you're making, especially as the auto workers took pay cuts and were supposed to get engaged in revenue sharing. This is what the GM strike's really about. Back 10 years ago, the workers and the union agreed to take pay cuts because to keep GM alive, and then they participate in the profits going forward. GM has basically screwed them. They're making a ton of profits. They have not really paid the workers what they're supposed to. So that's what the strike is mainly about. And that was it for yesterday, I guess. Okay, and then today we didn't really talk about too much new stuff. So let's see if there's any questions. No questions, boy. Okay. I want to take a look at the EIA report. Let's see, is this today? Through September 20th, yeah, this is today. So the headline, there's a 2.4 million barrel increase in oil, gasoline increased by 500,000, and distillates went down by 3 million. So the net is about net zero. There was no particular build. In reality, the build was from 1.7 to 2.4. So there's actually a 700,000 net build, and that's probably because all other oils, and here it is here, all other oils had a build. But honestly, on the whole, it's pretty flattish. So there wasn't as much reason to panic as the API report showed, because the API report got people nervous. It had pretty big builds. And so we're hanging out now around the 56 line or whatever. It was as low as 55.50. But we didn't play it. We were just watching to see what would happen. Oh, what'd I do? Yeah. So here's oil. So it's not nothing great to recover over or anything like that. Just more of an interesting thing. So what else happened? Exports, net imports. We're still exporting 3 million barrels a day. We're still sending out of the country. So that makes the demand very fake. That's 21 million barrels a week, and here we are producing 21 million barrels a day. So 1 day a week we send out of the country. That's how much of our demand is not U.S. demand. And that's a funny thing, because they'll say U.S. demand is this much. And it's used in many ways. It's used to say, here's how much an industrialized country uses. There's so many fake ways they extrapolate it out. They say U.S. demand is 21 million barrels a day based on this figure, right? But it's not, because we're sending out 21 million barrels a day to other countries. But what they say is, they say when other countries get to the level of the United States, their demand is this much. Or if the United States does this or that, you extrapolate out the numbers in all sorts of ways. And they talk about if the US cuts this much and so on and so forth. It's all messed up, because your underlying base assumption of how much fuel we actually consume as a country is wrong by a large factor, by like 15%, 1/7. That's a pretty large amount to be off. So you have to be very, very careful with things like that. You know, there's a lot of places where you'll see that, where the underlying assumptions are just dead wrong. So we imported 100,000 more barrels a day. That's 700,000 barrels right there. We imported 100,000 more barrels of oil. We exported the same, so our net went up a bit. It went up, not a bit, our net went up 100,000 barrels. So we did import more than we exported. But again, the funny thing here is, if we weren't exporting 3 million barrels, we would not need to import 3.6 million barrels, would we? We'd be importing practically nothing if we weren't exporting product. There'd be no need for us to import. So we are effectively import free. We are energy independent. And knowing that, if that was a known fact, then the price of oil would be much lower. If you know the US doesn't need anybody else's oil, it would make it a lot harder to sell the fear story of oil supply. We don't need other oil. And this includes, by the way, Canada's oil and Mexico's oil. We don't need other oil. We're only importing it because we sell finished products to other countries. If we weren't selling finished products to other countries, and by the way, it used to be a law that we couldn't do that. You weren't allowed to export gasoline and stuff from the United States because it would just increase the imports. That was logical. But they changed the laws on that, and now you can export gasoline and other chemicals that you make out of oil. And that's what they do. So now they ship out 3 million barrels a day, makes it look like our demand is 3 million barrels a day higher than it would be otherwise. And it leads us to be, we're not a net, we're a net importer of oil, and we don't have to be. We would actually be energy independent. So we hit that goal, it's just nobody knows it, and nobody talks about it. And if you did talk about it, then nothing the Arabs did would matter. How would anything that happens in Iran affect us? It wouldn't. We don't buy, if we bought no oil from overseas, you wouldn't care if they blow something up in the Persian Gulf. And that then affects not just the price you pay for oil, but it affects our entire foreign policy and the way we look at things. That's what's crazy. One stupid thing like this, and it affects so many other things. It affects our entire way of life. Just because people fudge statistics or make numbers look a certain way, or even worse, the reporters who report on these numbers don't even bother to do the basic research to understand what they're reporting. Like consumer investor confidence today. We talked about the investor sentiment today, and it was better in the rest of the world, but it actually got worse in the US, but it doesn't matter because the headline number of State Street investor confidence is up. Everywhere in the world is up except the US, where it went down more than 10%. But that's not going to get reported, and investors aren't going to react to it, and the markets won't react to it. And it's so weird. I mean, it really is. It's very strange when you read things and you're the only one reading them. And if I talk about it, people are like, oh, you're nitpicking. I'm like, I'm not nitpicking. That's what it said. It was plain as day. It said that U.S. investor confidence went down considerably, alarmingly. Something that should worry normal people, but it's not. I don't know if I linked to the article, but I had it. Oh yeah, here it is. This is from the actual State Street report. I was reading I'm very weird, I know that. I'm like, I actually read the report. Like, I don't just take the number and write it down. I'm like, what does it actually say? So, global institutional investors reduced their exposure to equities at a slower pace in September. So, reduced their exposure to equities at a slower pace. So, they're still reducing their exposure to equities, but just not as fast as they were. According to State Street, investor confidence index based on actual portfolios of their institutional clients rose 80.1, up 3.3 from August, which was revised to 76. Risk appetite rose mainly in Europe, and it jumped 18.5 to 107. Now think about that, 18.5. That means it wasn't 90. It jumped 20% in Europe. Our index fell 1.7 additional points to 71.8, and Asia fell too. So only Europe, for whatever reason, jumped up. And it's possible that a lot of money is moving out of England and into Europe, which may have caused a spike in Europe, not because everything is so great in Europe, because it sure isn't. But things are a disaster in England, so it's possible that the English people with money and the institutionals in England are moving their money out of England while they can still do transactions in euros and move things across, because there's that October deadlines here. So, and that's all up in the air now. We still don't know what the hell is happening because of now Parliament's coming back and Johnson's in trouble and all that. Who cares? The bottom line is that North America's index fell horrifically. We're at 71.8. We are so far lagging. It's not confident. You can't even call it confidence at 71.8. 100 plus is when you're confident. This is lack of confidence. That's a big deal. But you won't hear it. You know, watch the news, read the financials, see if anybody tells you this except me. It's scary. If you don't get the whole story, how do you make an intelligent investment decision? So things are not quite as good as they seem. Awaiting President Trump meeting with the Ukraine. Oh, he's having a special meeting now with the Ukraine president. Look at this. Live in New York at the UN. And the Ukraine president is smiling. So Trump has done what I thought he would do. Trump has made him a deal that he could not refuse. Oh, wait, let me see if he's saying something. Wait a minute. Trump's talking about the guy's reputation and why he got elected. Isn't he the comedian? Yeah, he's a comedian. His previous job was a comedian. He played the president in a show, in a comedy show. So Trump is impressed with his experience. All right, Trump just totally kissing this guy's ass.
But I know that you've never been in Ukraine, and your predecessor also, didn't find time. So, can you assure that you will come to our great country?
This is mutual ass kissing going on right now. Trump is talking about having owned the Miss Universe pageant. This is what he's talking about at the UN. And he had a winner from the Ukraine. And that's how he got to know the country really well, because Miss Universe was from the Ukraine.
But I think you can go to 70 I think in the New York
Oh, the Ukraine guy's got a sense of humor. He's making people laugh.
Many people, many places, thank you for your support, especially now when we have two wars in Ukraine.
Says thank you for your support.
And that priority, my priority is to focus for Donbass and our territories, Crimea, Donbass, Lugansk.
He wants to get Crimea back, of course.
In these games, thank you very much.
Oh my God. Trump says, if you remember, you lost Crimea during a different administration. During Obama, you lost Crimea.
And I think they need to get a little work on it. And I feel a little bit guilty about it because they don't do that. They shouldn't do it.
Trump says other countries should feel guilty. They're not helping Ukraine as much as we are. They said semi-appropriate for discussing at the UN. All right. I was concerned that we not alone in the country. And unfortunately, from this house, we need support, real support. And we thank everybody. I think. We're waiting to see if he says something about this impeachment thing, but. Only together, America, I mean, there's just no reason this would be happening other than the scandal. Why would Trump be sitting with the guy from the Ukraine having a press conference? You have great people in the Ukraine in terms of some of the things you do, Trump says. Talented people, great things, top of the line. He knows nothing. He says he heard they made progress in Russia. I wonder who he heard that from. This is going nowhere. I can't take it. Anyway, all right, so we know nothing. But nothing, no bombshell so far. I know nothing either way. Markets are just bombing along. Very nice. Up a half a point here, up a half a point, more than half a point, up a whole point on the Russell. So all bouncing. We're back to where we were and looking at 27,000 on the Dow here, getting towards 3,000 again on the S&P. But we expected this because it's at the end of the quarter on Friday. So, we expected things to get propped up a bit. Durga says, Phil Market Top, sorry I joined late. Did you short ES or any other indexes during the webinar? No, we didn't actually. We're not really. This morning we talked about shorting the ES at 29.70 something, and we got a little bit of a dip, but it was not exciting. It went down to 29.60, so it wasn't, it's not nothing. It's $500. I don't know. What I say about ES? Control F E S. Let's get the actual thing. So I think a good short below the at 29.6750. Now 29.72. A very tight stop. So we're hoping to get to 27.50, 29.50, but we never made that. 29.53 was the lowest it got. So we made if you took this money, it was 7 points, and that's like $350 a contract, which isn't terrible. But and then there was another chance to do it again over here, and another one, but it never really got down as low as we hoped. So that's the only thing we looked at as far as playing today. And honestly, the same turmoil that made me go to cash in the portfolios makes me not really want to. I'm not jumping on futures plays. I liked coffee because it was stupidly cheap. So we have, I don't know where it is. All right, well, let's put it here since I don't see it. KC. So I like coffee because it was stupidly cheap yesterday. I said so, and that's one I could get behind. Orange juice also stupidly cheap. But those are obvious bottoms, as opposed to there's no obvious top in the S&P, and we didn't know which way this impeachment stuff was going to go. Obviously, it's working out well here for the moment. Now Trump is saying Biden's son walked away with millions of dollars from the Ukraine. It's all about Biden.
He was elected, I think, number one on the basis of stopping corruption, which unfortunately is great. And it's a dude that he's doing really the whole world a big favor.
The Ukraine president said he doesn't want to be involved in the U.S. elections. Trump says Rudy Giuliani is trying to find out where this phony witch hunt started. That's crazy. He says Rudy is being passionate when he goes crazy on TV. All right, sorry, I said I wasn't going to watch it, but it started getting more interesting sounding. The Ukraine president says Trump and I had a good, normal phone call. So he's on board with this. As I said earlier, he's going to just basically toe the line and get behind Trump because Trump can help him right now, and anybody else he's going to have to wait for over a year to get help from. So that's not going to work. And Trump, it's very interesting. So Trump is feeling very good about all this stuff right now, like it's not going to touch him. Anywho, so let's see if we have any other questions. Otherwise, we're going to be ready to wrap this thing up. So everything's pretty normal. We're, as I said, we're bargain shopping. We're looking around. We're finding stocks that are decent deals. And but at the moment, we're really not doing anything until earnings. So I'm sorry, it's not going to be very exciting, but we're basically earning. We got a whole month of October. Things will start trickling in later in the month. Then we've got the election, which is not a big election, just the November elections. After that week, though, coming back November 10th is, and that's a whole month away. But until about November 10th, and we start getting to the next earnings season, that's when we're going to be able to start picking up bargains. Between now and then, I'm going to be identifying, probably end up identifying 30, 40 stocks that we are interested in, which is going to be a tenth of the S&P 500 practically. We'll identify what we are interested in, and then as we see, we'll wait patiently to see if they get cheaper. In fact, you can see that off our own watch list, because we have a watch list. It's on the portfolio tab. Got to go back far. September 2018. Top trades, portfolios, top trade watch list. Here you go. So way back in 2018, this is when we didn't have a portfolio. This is what our watch list looked like. And you can see we had Apple, which obviously did very well. We had ABX, which is now Barrick Gold, doing very well now finally. Alaska Airlines. We ended up picking up most of these things. Best Buy didn't really do well, but didn't do much worse. It did well, and then it didn't do well. Boston Properties, fantastic performance overall. And you see what the plays were. We sold some puts, and here's this: sell some puts in Cheesecake Factory. Chicago Bridge and Iron got bought by MDR, so they're gone. We made money on that. CDE, another miner. They were terrible, hard to make money. Then we got all the money back. CHK, still terrible. All right, that one we have taken the loss on, I think, overall. CIM, fantastic. We're out of them already, but they were great. Cleveland Cliffs, we played, made money, got out, came back in on the whole. But we started off selling the $10 puts for $370 back, and this is back in the beginning of 2018. So back over here, we sold these puts for $370. And we got out of them somewhere around here, and then when it went down, and we bought some more, whatever. ETE, I don't remember what happened to them. Ford, of course, was a good one. We have them; they were a dividend stock. FNSR did pretty well overall. Frontier did terrible, not at all what we expected. I'm still interested in them though on the long haul. That's a nice dollar stock to play. GCI did very well. They've been up and down, but they did good. GE was a disaster. They fell apart, but they're I mean, on the whole, they're back, but not where we started. You know, we doubled down on them and got out eventually. Gilead has been up and down the whole time, so they're one we probably get back into. There again, you want to buy them lower in the cycle. When they were down in the cycle, we liked them. We love them at 65, and we can sell them. And we sold the 65 puts for 810. So, you know, who cares? We eventually turned it into a plane, did other stuff, but that's how it works. GNC, we sold the $5 puts for $3, so we're netting in for 190. It's 250 now. GoPro, we sold the $8 puts for 375, so our net was about 4, and this is where we are. It had gone much higher. We already got out. We're not stupid, you know. When it went up to here, we got out. And we didn't stay in. We're like, oh, that's great. We made most of our money. Let's get the hell out. HRB. Now here, this one is funny. We always do this. They always come down like this, and then we buy them, and then we wait for tax season, and everybody remembers that they make money, and then they go back down. It's great stocks to come in and out of. IMAX is one I said I would definitely keep going forward. Anytime IMAX is around 20, we buy them, and that's been a winner. LB, big disappointment. That's one I would like to get for the future. Macy's, huge disappointment. Another one I want to get for the future. Here we sold the 22 calls, the $15 puts. It's still $15, but I mean, so even this original trade wasn't so bad. But we've been in and out of Macy's also. NLY is another REIT. They're down pretty low, but that's a little too risky. I wouldn't go into those guys. PSA went flying up and never stopped. SKT is my favorite REIT right now. I like them. We want to get back into those guys. SunPower really took off, so that was a big winner. 712, that's where they were, so they were way down. Target, another huge winner that totally got away from us. Tenet Health, we got out over here, we got back in, now we're out, but I'd love to get back into them again. They were just one of my 5 stocks to make $5,000 by, 25. 5 stocks to make $25,000 in 5 months. I just picked them because they were low, because when I made that list, it was down here. Wheaton Precious Metals, we made money a few times in between on this one, still fantastic. And Whirlpool, fantastic. Wow, what a list. I mean, geez, just follow that list and you can make a fortune. So we're gonna make another list just like that. You know, and it starts out as a watch list, and then it becomes more of a buy list. And the difference between a watch list and a buy list is a buy list means that when it gets cheaper, we're gonna definitely at least sell some puts. But if you read through these things, and it's on the portfolio tab, and all you have to do is go back one section. So I'll do it again if you want to. If you want to do your homework, you go to the portfolio tab, and then you go to older articles, because it is an older article, and then you just go down until you see it. And oh, here it is, watch this update. In fact, now when I add another article, it's probably going to fall off and go one more back. So you'd have to actually hit the back button again. But this is how we make a watch list. Just like that. And then most of the recommendations were to say, well, we start off with a short put. But the real trick to this thing is you don't jump in until you see them come down a bit. If they come down 10, 20%, then you're going to sell a put and get another 20% discount. That's the trick. So, that's the kind of list we're going to make again. As you can see, that one was fantastically successful. And this was a list we made after we cashed out our portfolios in Thanksgiving. So we're a month earlier than last time. So in that cycle, we had cashed out our portfolios in about November of 2018. I'm sorry, 2017. So we cashed out November 2017. Oh, this is the watch list update. No, I'm sorry, that's the update. That's right. Oh, I see. And then I updated it here. So we have the watch list. So right after we cashed our portfolios in November, we did this watch list. And it says 20, I had 24 stocks at the time. Then we did this watch list. So between November and January, we hadn't bought anything. We didn't even have any portfolios. from November to January. Then in January, the market had gone down and we said, now is the time we want to start buying things. And we started putting on all these plays. Before we were just watching them, then they got cheaper and we jumped. And that's what you do. So now is the time to prepare and get ready so that when the stocks get cheap, we know exactly which ones we want to buy, how we want to buy them, what we want to pay, so on and so forth. So that's our job for the next month or so, is to get prepared for that. And if we never have a big drop, if we never get a great opportunity, we'll still buy them. We'll just buy them more cautiously, like one at a time. What happened in January 3rd is we bought a whole bunch of stocks on January 3rd because it was too good of an opportunity to pass up. The market had really come down a lot and we wanted to get in. So that whole month we spent buying a lot of stuff because we got the correction we wanted. If we don't get the correction we wanted, we'll still sell puts, we'll still put a few plays on, but we'll just be more cautious about it. And we won't get off to such a fast start as we did last time because we got that sell-off that was very well timed. But hopefully between now and January, we get a nice sell-off. If we don't, you know that out of 24, 30 stocks that we end up on a watch list between now and earnings next month, that at least, let's say five of them out of 24, out of 24 stocks, 20%. 5 of them are going to come down because of bad earnings or whatever. At least 5. And so we know we're going to have 5 good stocks to start portfolios with, probably more. And then other stocks that we're not even thinking about might go on sale. Like if Coca-Cola drops 20% on earnings tomorrow, I'm going to take a damn close look at Coca-Cola. And unless I think it's going to drop another 20%, I'm going to certainly take advantage and sell puts at 20% out of the money. You know, unless I think people underreacted and sold Coke off 20%, I'm going to say it's freaking Coke. Unless they murdered people or something, I think they're going to be fine in a couple of quarters. And again, what are the trends? Global warming is a trend. Election turmoil in the U.S. is a trend for the next couple of years. You know, automation is a trend. As again, will your companies be affected by automation? Will your companies be adversely affected by artificial intelligence? And by the way, a lot of the fast food companies will be benefited by that stuff. Automation, artificial intelligence can be a huge help to a lot of fast food companies. Anything with like unskilled labor, you have to think about, wow, how many laborers can we get rid of? You know, Amazon is practically, or you know, it practically doesn't need people on the floor in their warehouses. They got computers, they got machines doing it all. So, you know, is that a benefit? It's a long-term benefit. It's not a short-term benefit. Right now, they got the people and the machines, but eventually they'll just have the machines. And machines are subject in a sort of way to Moore's law, which means they get more productive and cheaper every couple of years. And that means that there's going to be a huge beneficial slope to companies with their productivity. It won't be human productivity anymore. It's going to be machine productivity. And that's going to suck for people, but it's going to be great for that. But then if that's going to suck for people, you're going to say over the next decade, then consumer spending is going to be a problem because there's going to be dislocations of people. And even if Andrew Yang does give everybody $1,000 a month, how much is that really going to help? So we are going to have to see how it all works out. But meanwhile, we're going to have fun making a watch list. We're going to have fun with everybody. If you have ideas, put them in chat, and let's talk about which companies we want to add over the course of the next couple of years. What do we want to be involved in, and what do we want to make our money on? It's going to be a very different portfolio than we had last time. But that's what makes it interesting, right? We want to make the portfolio that works now. And that's why I always say, it's like, there's not really a lot of point to going back and looking, although I did say IMAX I always love and blah, blah, blah. There's certain things I do love when they get cheap. But reality-wise, mostly it's going to be completely different stocks because it's a different 2 years going forward than it was going backward. And that's what we got to be considerate of. All right, guys, thank you very much, everybody, for coming by and listening, and we will do it again next week.